Why banks aren't lending to small businesses, a closer look. The landscape of banking has shifted significantly in recent years. The once traditional lending model has undergone transformations due to various factors. Let's delve into the reasons behind banks' cautious approach. Regulatory constraints. Bank regulators have closely monitored the industry, especially after witnessing bank runs on institutions like Silicon Valley Bank and Signature Bank in early 2023. In response, regulators have tightened the reserve requirements for banks. These requirements dictate the amount of money banks must hold in reserve to ensure stability. As a result, banks are more conservative, holding onto their deposits rather than extending loans. Anticipated delinquencies. Banks foresee potential challenges as interest rates rise and consumer finances become strained. The uncertainty surrounding a possible recession further exacerbates their caution. To mitigate risk, banks prioritize existing relationships and focus on large, established companies with lower risk profiles. Commercial real estate uncertainty. Regional and small banks, which traditionally lend to small and medium-sized businesses, face challenges. Their significant loans to commercial real estate companies are at risk, especially as remote work continues to impact downtown office spaces. The shaky outlook for commercial real estate affects lending decisions. Interest rate dynamics. Banks' cost of capital rises alongside interest rates. Consumers demand higher yields on their deposits, leading to outflows from banks to other institutions offering better interest rates. This liquidity drain affects banks' ability to lend. Inflationary pressures. An inflationary economy prompts banks to be more cautious. They anticipate rising delinquencies and defaults, affecting their lending decisions. Non-bank funding alternatives. The slowdown in bank lending has pushed businesses toward non-bank funding options. Entrepreneurs explore alternative sources such as private lenders, peer-to-peer lending, and fintech platforms. National Business Capital's diverse lender platform simplifies this process, connecting businesses with non-bank financing solutions. The changing landscape. Banks are not what they were a few years ago. Their risk aversion has intensified. Small and medium-sized businesses, once warmly supported by banks, now find themselves left out in the cold. Lines of credit are being demanded to be paid down with little notice or concern for former customers. In summary, the banking industry's cautious stance stems from a combination of regulatory pressures, economic uncertainties, and changing dynamics. While one door may have closed, alternative funding avenues offer hope for businesses seeking capital. Entrepreneurs must adapt, explore non-traditional options, and work closely with financial advisors to navigate this challenging climate. How have non-bank lenders filled the gap? Banks and credit unions are subject to the dictates of the economy, whereas non-bank lenders operate in the private sector and can make decisions as they choose. Most non-bank lenders don't deal in consumer/business deposits either, which allows them much more freedom and flexibility when lending. Non-bank lenders have gained immense popularity in the last decade, but the current lending environment has made them even more attractive. Here are a few of the ways entrepreneurs are leveraging non-bank options, even if they already have existing bank financing. Leveraging cash flow instead of assets for funding. Accessing additional capital outside of an existing facility with a subordinated debt solution. Negotiating their terms to align with their opportunity/challenge. Non-bank lenders are much faster, more accessible, and, most importantly, are offering access to capital right now. They don't need assets, and they don't always require you to pay off your existing financing. Email for instant callback or send me your questions. Shammy McConnell, skyloansnow@gmail.com.